Okay, so welcome back to the trading desk. We're going to move on now from consumer price index, so the consumer inflation in the US economy. We're going to move on now to business inflation, and we're going to look at producer prices and specifically the producer price index. So when we're looking in the United States at business inflation, we're looking at producers of manufactured goods, so real goods that are sold into the economy to consumers at their final prices. So we'll start looking at inflation of the PPI. Now, we learned a lot from the CPI because the CPI, as an economic indicator, we learned from it very quickly that inflation is actually extremely normal, and inflation is normal in any capitalist economy. And we also learned a breakdown of the CPI from the CPI including food and energy prices and also excluding food and energy prices, and we learned that they behave quite differently. And through the whole process that we applied a statistical distribution to discover or gauge what is considered to be normal and what is considered to be abnormal inflation in both the CPI including food and energy and excluding food and energy. So what we have to do is go into business inflation with the same mindset and the same process. So when we go to look at business inflation, what we really want to look for to begin with is a long data set. So we don't want a small data set, we want to have confidence in analysing what is normal and what is abnormal. So we need a data set that's going back as far possible as we can get to actually gauge inflation through a long period of time, so we can actually discover what's normal and what's abnormal, so we have more confidence in our decision making. And we're trying to get to this point always where we're using economic indicators such as inflation to gauge inflationary and deflationary circumstances that will lead us to a strong bias whether to go long or short the currency in absolute terms. So whether the currency, in this case the US dollar, is losing or increasing in its value. So let's go over to the computer screen. Let's start applying the same process that we applied to the CPI. We want long data set going back as far as possible. We also want to start gauging what's normal and what's abnormal through statistical distribution, with the purpose of getting to a point where we can systematically scorecard a strong currency bias either way as part of our overall systematic process. Let's go over to the computer screen and I'll see you on the other side.
Okay, so welcome back to the computer screen. What we're going to look at now is the PPI, so the producer price index, and specifically in this video we're going to look at the producer price index including food and energy. So the including food and energy code that we need to look for is the PPI FGS. Now the PPI stats including food and energy and excluding food and energy are released during the second week of each month for the previous month by the US BLS. There's over 10,000 PPI data series that are actually available. The headline number that you see reported in the media is the PPI final demand number, which is split up into PPI final demand seasonally adjusted and PPI final demand ex food and energy seasonally adjusted. The problem with using this number is that we don't get any historical perspective. The data series was created in 2009 and the old series was discontinued. So it's quite convenient that it was discontinued in 2009, just after the financial crisis and prior to the Fed's quantitative easing program. So what we mean by that is they've redefined inflation. And as we know, a monetary lever like quantitative easing is designed to spur inflation. And if you're a conspiracy theorist, I guess you would question why the definition of business inflation all of a sudden changed in 2009. So the final demand number is not a number that we're going to use because the data only goes back to 2009. What we're going to do is we're going to look further back, and we're going to look at the PPI series called the PPI finished goods seasonally adjusted number, so PPI FGS. And there's 3 series within this PPI. We have finished goods, which is commodities that are ready for sale to the final demand user. We also have intermediate goods, which are commodities that still require further processing. And then we have crude goods, so unprocessed commodities that are not sold directly to consumers. So what we're going to focus on is the PPI finished goods, so actual goods that are ready for sale to the final demand user, so the consumer. And we can go to our old friends, the St. Louis Fed, to retrieve the data for both the PPI FGS and the PPI FGS X food and energy. The data is available going all the way back to 1947, which is what we like. So where do we actually get this data from? Well, we get it from the 2 links here. If you go to the top link, we can get the PPI including food and energy from the St. Louis Fed here from this link, and X food and energy from this link. We'll go to the links in a moment. But how do we analyze these stats? Well, we do it in a very similar way to the way in which we analyze the earlier CPI data. We calculate a distribution of returns to discover what's normal and what's abnormal. So we can scorecard inflation and deflation accordingly. We take the monthly rates and work out percentage changes on a month-by-month basis, and we look at a trailing 12-month number to gauge inflation or deflation in producer prices and compare the number to the historical distribution of percentage changes. So you should be getting very familiar with the process here, how we analyze our economic data. We can go to the endogenous driver analysis spreadsheet over here, and we can start to look at the data and how we work this out. So we want to be here in the PPI FGS tab here. But first, let's go over to the sources tab. And you can see here in inflation on row 16, we have our CPI and our PPI stats. We're going to focus on PPI here and click on the link for the PPI all item stats at the St. Louis Fed. This takes us over to the St. Louis Fed website. We click on download and our PPI data within seconds comes up on the screen. And you can see again we have 2 columns. We have our date going up incrementally in months and our PPI all items value. And if you scroll right to the bottom, you'll see that we have our latest months here, and you can start taking this data, and all you need is 2 columns to start the entire process and to build an analysis to really understand the historical behaviors of the PPI number, PPI all items. So let's go back over to the endogenous driver analysis, and if we just click into the PPI finished goods all items number, you can again see we have our date going up in increments of months. We have our PPI finished goods value here, and we have our percentage change in the value in this column here. If we scroll down, you can see that we have our GDP stats as well. And the GDP stats are going from, again, October 1954. And when we analyze our data set here, what do we have? Well, we have our intervals again, and we're using the same intervals as the CPI. So either side of 0, we're going up in increments of 0.5% up to 1.5%, and in the negatives, we're going down in increments of 0.5% down to minus 1.5%. So as you can see, it's a very similar analysis to CPI. We then crunch the numbers. We have over here our stats when analyzing within these parameters. So we have our frequencies as usual, so the amount of occurrences that happen in each area. We have our labels, we have our probabilities, and we have our cumulative probability. So this is the probability of one of these happening throughout history or compared to history. And the cumulative probability, so 100% meaning all cases, and here 38% of cases being 0 or below. Over here we have our descriptive statistics, so the behavior of our data across the entire data set. Up here we have our average and our count. We also have our average positive and negative situation. So when a month is positive, the frequency and the average moves, both on an absolute and probability adjusted basis, and the same for the negatives, so negative months, and then for 0 months, we just have the frequency. We also have the comparison between, or the ratio between positive and negative months. Over here, we have our statistical analysis when we compare the distribution of the data versus a normal distribution. We have our scorecard down here, which we will come to later. And down here, again, we've represented the data pictorially for you, so you get a good sense of what we're looking at here. Here we're looking from 1957 onwards to present day, and this is the PPI finished goods seasonally adjusted against relative against real GDP growth. And the data set does go back here to 1947, but we're looking at it here from 1957. So we can just actually change that chart. So we're zooming on in on this period. In red, we have real GDP as a percentage. So this is real GDP here. We have the increments of 0.5% in the PPI finished goods percentage change month on month, and that is in blue. So that is this data set here on the chart. And you can see throughout history that there's a decent correlation here between the percentage change month on month in PPI, including all items, and real GDP growth. We actually can zoom in, as we did earlier with CPI. We can zoom in here to a more recent period. So we're looking at the period 2005 to 2015. And when we zoom in, we can even see this a bit more closely, that PPI all items is pretty well correlated to real GDP. Also, something that's pretty key that we shouldn't forget is our line of best fit. Our line of best fit is basically the long-term mean or average trend line of the monthly percentage changes in PPI, and we see that this number here comes in at around 0.25%. And if we scroll up here, we'll see that our average runs at 0.25% here. So that's obviously the same thing, pretty accurate. And we're just visualizing this. We're looking at this pictorially. And 0.25% increase in PPI finished goods over this time period is associated with levels of around 1% real GDP growth. So this is how, again, we begin to build out our scorecards. So let's go back to the presentation again. In your own time, obviously you can play around with the data, have a look at it in more detail. But for now, let's continue with the analysis. So how is it we are looking at these numbers? What do we find out? So again, we're looking at what we can consider to be as normal and what is outside the bounds of normality. We do that by taking a distribution of the monthly percentage changes to discover the behavioral nuances of business inflation or deflation, as the case may be. And again, we discover immediately that there's a lot more positive data points than negative data points. So a lot more inflation than deflation. But we do have negative data points here. The positive data points, actually, the increases outpace the negatives by a factor of 2.63 to 1. So we can see straight away that this ratio is not as extreme as the CPI data. The long-term monthly average business inflation rate in the US is confirmed to be about 0.25%, which is what we saw earlier when we looked at the spreadsheet. The average inflationary month, so the average positive month, is 0.5% or 0.56%, and the average deflationary month is minus 0.42%. So probability adjusted monthly inflation, when we multiply across the frequencies in the positive month, so probability adjusted inflation is 0.3454%, and probability adjusted deflation is minus 0.0986%. So for the negatives, for the down months. Again, you can go into the endogenous driver analysis. You can double check all the numbers, and you can even start from scratch from a blank spreadsheet and work all of this out yourself. What happens when we look at the distribution from the perspective of standard deviation? Well, one standard deviation of the sample, so one standard deviation of all of this data is 0.575%, as confirmed in the descriptive statistics. In the upper bound, one standard deviation is 0.8229%, and in the lower bound, minus 0.3271%, and 77% of these months of the data falls between these values. And when we compare this to a normal distribution of 68.2%, which is a one standard deviation move in a normal distribution, this basically again means that the data we're looking at is peakier, so a lot more values around the mean, and has fewer but larger fatter tails, so bigger outliers, and then a vacuous situation when compared to a normal distribution in between. So we can see again that this economic data is shaped or behaves in a more peakier fashion relative to a normal distribution, and has larger but fewer tails. So we have our basic statistical analysis there of all the data. how do we start to interpret this? Well, the interpretation, as you probably guessed, is going to be quite similar to the CPI. Given that one standard deviation of the PPI finished goods is 0.575%, and that this is occurring 77% of times, this means that 23% of the time there are numbers outside these parameters, outside the one standard deviation moves. And these can be considered shocks, so either significant inflationary pressures or significant deflationary pressures. However, in all cases, the inflationary pressures will outnumber deflationary pressures by a factor of 2.63 to 1. So again, it's very obvious that inflation is normal. But here we're looking at business inflation, and we have to distinguish between types of inflation because they do behave slightly differently. But in the overall sense, it's pretty obvious that even with PPI, all items, inflation in business is totally normal in the US. And in fact, it's required. Monthly deflation occurs in 23% of months, and no deflation, so zero values, occurs in 15% of months. So it can be said that there is no inflation in 37% of months. This is actually quite different from our CPI data. So if we compare this to CPI data including food and energy, that showed no inflation and deflation occurring in 15% of months. So what this actually does, historically, it shows that businesses in the US may not be passing on lower food and energy costs to consumers. However, they pass on higher food and energy costs to consumers when there is inflation. So let's make sense of that. If in 37% of months, when we have business deflation or no inflation, and then at the same time in the CPI, when we have no inflation or deflation in 15% of months, this means that the lower prices are actually not being passed on in those months. So when we compare the data historically, otherwise lower prices would have been passed on to the consumer. And we would see that in 37% of months, the CPI data, including food and energy, would actually have no inflation or deflation. So we can see a little bit of a difference here, which is quite interesting. And I guess, when you look at this in the bigger picture, in trading and portfolio management, we tend to learn something new every day. That's a pretty interesting analysis.
So how are we going to start building out our scorecards here? Well, our sliding scale has to take into account that business inflation is totally normal in the United States. So we're not going to score highly for normal rates of inflation and growth. If there is inflation, we're going to have a short currency bias, but when it's within the normal bounds, we're not going to assign a high score to it. Now, a minor long bias score in the currency occurs when there's deflation at 0 or below, because history tells us that this occurs in 37% of months. So it's quite common. So monthly business deflation in the US, when we look through history, doesn't simply occur when there's GDP contraction. Zero inflation, so zeroflation or deflation, occurs quite frequently throughout history, even during GDP expansions.
So don't forget, we do have to analyze data and make sure our analysis is robust. So let's not forget also that this is the PPI including food and energy. So when we think of this in the bigger picture, maybe we need to drill down and see what's going on here. Because this can actually be a simple case of oil prices falling or some sort of oil price volatility that we experienced earlier in the CPI stats. Now, if you filter the spreadsheet for months below minus 0.05%, what you're going to find is that there's 45 months or cases when deflation is less than this. And actually almost half, so 21% of these months occur after the year 2000. And this isn't a coincidence, because we've actually had a period over the last 15 years of historically high and volatile oil prices. So these two things are actually going now hand in hand. We have a very common occurrence of zeroflation and deflation of 37% of months. But when we actually dig into what this deflation is being driven by, it's quite obviously being driven by historically high and volatile oil prices. So when oil prices go high, we get spurts of business inflation, and when oil prices drop by similar amounts, we get spurts of deflation in the business sector. So if we just continue with the analysis in terms of our scorecards, when deflation begins creeping and is fairly small, we tend to have a minor long currency bias because deflation is common. And when deflation is extreme, we tend to have a short currency bias predicting inflation because it's apparent that the Fed will act sooner rather than later. And if we go into the positive values, so let's go into the positive area of our potential scorecard. In the spreadsheet, if you filter for values greater than 1%, what you're going to find is 66 cases of monthly PPI above 1% since the records began. And you're going to see that many of these occurred in the last 15 years and during the 1973 to 1974 oil crisis. And this is now going hand in hand with when we looked at the deflationary periods. After big percentage moves up in oil, we get sometimes, or a lot of the times, big percentage moves down, especially if we look over the last 15 years. So when we have extreme inflationary pressures, these tend to occur when there's significant growth in the economy, or at the end of cycles prior to slowdown, so before deflation, or when the Fed acts aggressively to spur inflation in a crisis. So all this adds fuel to our argument that in periods of severe deflation, we must have a very strong short currency bias. And similar to CPI scoring, we do have that short currency bias on the extreme inflationary moves as well. So now we're starting to get a sense of how the PPI finished goods number actually behaves historically. And remember, it's including food and energy. So how this number actually behaves on a standalone basis, and even when we're comparing to our other main inflation statistic, which is the CPI. Let's remind ourselves what this looks like pictorially. Well, we're taking the same approach to our scorecards as when we looked at the CPI, all items, and we're correlating normal inflation with normal rates of growth. And those normal situations are going to get a low bias scoring in terms of numbers. And as we pointed out in the spreadsheet earlier, we have our line of best fit, which is the long-term mean average of monthly PPI percentage changes. And all of these percentage changes are associated across the chart with varying levels of real GDP growth. And zooming in, we have the same analysis here, but for 2005 to 2015, and we can definitely see a trend where positive changes in PPI, including food and energy, are associated with positive GDP, negative associated again with negative, and we can see that not all of these are associated in the negative with positive GDP. As we've already seen, this can also be because of high and volatile oil prices when compared historically. So let's have a look at our scorecard analysis and go through the basics of our scoring system. So again, this systematic scorecarding process, how we go through the entire breakdown, how we score things, this should be becoming fairly familiar to you now. Again, we have our sliding scale of inflation, we have our associated GDP levels, and we have the scores that we assign to each level of inflation and associated GDP growth, and our zones of short bias inflation, long bias deflation, and short bias predicting inflation in the future. And it's very similar to CPI and other previous scorecards in that during the benign circumstances, so within the extremes, the normal range, when inflation is within one standard deviation, we have two main areas. So we have our deflationary area. If we look at this first, when deflation occurs, we tend to have a long currency bias. And this slowdown, the deflation itself, is usually an occurrence of tight monetary policy or due to a negative economic shock, like the oil price falling, the housing crisis of 2008, the terrorist attacks 2001, stock market collapse of 2000. If you filter in the spreadsheet for the negative values and correlate this, read across to GDP and the dates, you'll see that there's a lot of data points that correspond to these time periods. And future policy is to loosen on the extreme moves. So reactionary authorities, the Fed reacting to large amounts of deflation. And we tend to have a very strong bias to the short side here, predicting inflation. And again, we score deflation low in conviction terms relative to other data sets because deflation in business in the US happens quite frequently, so 37% of times. Now, when inflation occurs within normal range, we tend to have a short currency bias because high growth is usually an occurrence of normal or loose monetary policy. And future policy is to tighten in the extreme and normalize after or during the extreme increases, unless, of course, there is a crisis. Now, if we try to cement our understanding of this a little bit further, a bit more detail, the closer that we get to this extreme deflation level, it's now pretty obvious in these circumstances that we have a higher likelihood of a future loosening monetary policy. And the closer we get to extreme inflation, the higher the likelihood of future tightening or normalizing, unless, of course, there's a crisis. And this is why, again, we have a neutral bias here, then a short bias all the way up the positive side of our PPI scale, but then diminishing in the extreme. PPI prices spend most of their time inflating, 77% of the time, and at a predictable and normalized rate of around 0.5% a month, which is why we score a short bias low on the scale here. When deflation occurs, so 23% of the time, it's more than likely that the Fed is reacting to overheating in order to deflate. And this actually isn't an uncommon occurrence. So deflation itself, which is why we score the same for a long currency bias in deflationary periods versus the short currency bias during inflationary periods. So we can see here in deflation we have a -2 and a -4, and here we have a +2 and a +4. So within these normal bounds. One interesting point to note, if you count the scorecard, there's 13 in total in terms of occurrences. 8 of them are inflationary short currency bias. 3 of them are deflationary long currency bias, and 2 of them are neutral. And the scores themselves are more extreme, so higher in total for short currency bias versus long currency bias. So there's absolute higher values and more of them. And throughout history, you'll see stimulus when economic crises occur. That's designed to counter deflationary conditions by causing inflationary pressures. And the more deflation that occurs, clearly, we're going to have more conviction that the authorities will step in and deal with it. And in the opposite, we have a fall in conviction when significant inflationary pressures occur. That's because when inflation gets out of control, it's more than likely that future policy will be to tighten. We then may enter a deflationary period, and we've got to be prepared as traders to switch from a short currency bias in our minds to a long currency bias. So jumping from here down to here. And if you've ever heard the phrase, a good trader is a flexible trader, well, there couldn't be a better example than this in macroeconomics. So being able to analyze the macro data systematically and being able to make an informed decision and switch, change your mind. So being able to flip from seeing large inflationary prints from the Bureau of Labor Statistics, assigning a high short currency bias, and then as the prints get higher and higher, being able to realize that these are extreme situations and that there's going to be tightening and flipping to a neutral or long currency bias, and in the opposite, flipping from being a deflationary position and then flipping to becoming a trader that's predicting inflation because we're seeing the extreme circumstances. Now, how do we actually go about assigning a score? Well, we take a similar approach as before. We take the average monthly price change of the last 12 months, and when we do that, it's coming in at 0.2947%. And if we analyze the data in the last 8 months, what we've seen is that they're all deflationary months between minus 0.0485 to minus 0.2484. So that's our range of deflationary months in the last 8 months. But in the last 8 months, they've all been deflationary. And there's no surprise there. It's probably in large part to do with oil prices. And this basically provides us with a score of around minus 4%. So the minus 0.2947, call it minus 0.3. We can see that it's going to be between minus 2 and minus 4. So depending on how conservative you want to be, how aggressive you want to be, you scorecard accordingly. Okay, so now we're going to go straight into the PPI excluding food and energy, and we're going to analyze that, and we're going to compare it to PPI including food and energy, and even compare it across to the CPI as well.